DCC, now that you're homies with RH, what's your thoughts on this 10K bottom theory? Well, basically, he just thinks that it's going to go lower because, you know, for the main thing that he's really looking at is basically the discount on the Ethereum. I mean, the BTC Grayscale Trust, and I think there's an Ethereum one as well. But the Grayscale Bitcoin Trust is, last time I looked, was about 40% off current market prices. So it's basically showing that there's not that much large investor demand because you can just go buy that paper Bitcoin and automatically get you're basically buying a full Bitcoin at 40% off. So until that starts closing up and stuff like that, it's not showing much institutional demand as well as like just regular consumer demand for BTC. That's one of the main reasons why he thinks it's going to go to the lower of that price, as well as charting wise, BTC usually can go down 80, 85%, 86%, and that pretty much takes it down to about 13 to 11K. So that's one of the reasons why he's saying that. So it's a lot of it's about Grayscale, and as soon as you start seeing bigger funds really start market buying and everything like that, so he's looking at a lot of things that we're not looking at, but he's been pretty transparent when it comes to how important that Grayscale discount is, and as soon as that discount becomes to a surplus, bull market's back on because there's now investor demand and appetite for risk. As well as there's one more thing you should be looking at is the market's basic, like we're pretty close to where the Fed's going to increase their rates. That the Fed, if they have the balls, the testicular fortitude to raise the interest rates maybe 2 or 3 more times, I personally think they're going to raise it one more time, and I think that's it because we are so close to the midterms that it's insane. So in September, we're probably going to get another rate hike increase, and man, it's going to be some big political turmoil and stuff if they end up increasing the rates again. Now, I think it's damn near full risk on mode again. Once the Fed says we're not increasing rates anymore, the bulls are out, and they're going to end up just start printing money, start investing in because the bottom's in at that point. Because this is something that I talked to personally with George Gammon about, was basically, the way he's structuring a lot of his portfolio right now is he has a lot of his dry powder in 1-year T-bonds. And essentially what he's kind of betting in a way is that within a year from now, that the rates are going to be lower than they are right now. So that's what he's betting on. So he's betting on that his dollars in those 1-year T-bonds let's just say at the price being $100, right? That when the rates go from the 3%, 4% that they're going to top out down back to damn near 0 or 1%, that T-bond is going to go up 30%. So and essentially what he's doing is he's leaving his capital he's willing to risk in 1-year T-bonds because he's in 1-year T-bonds because he's betting that the interest rates will come down because they have to. Now, I think the Fed knows that they're going to have to, the reason they're raising rates right now is obviously they're trying to curb the inflation. But at the same time, too, they need to have bullets in the chamber because they really only have 2 bullets. What are the 2 bullets they have? Well, actually, 3 bullets. Forgive me. 3 bullets that they have. 1, lowering interest rates to 0. You can only do that 1 time. Okay, cool. Other one, overnight repo markets. They can supply interbank lending and force it to give collateral to the banks. 2. And 3, printing and buying of bonds and other financial assets. They really only have 3 bullets, and they need to have the rate bullet up there because the rates are really it's the parking brake as well as the full brake, right? Obviously, the Fed doesn't have the kind of tenacity. Yeah, print money. Yeah. Yes, correct. Print money. Yeah. So